Greetings, everyone. Scott Richardson and Dan Brown from Richardson Capital Management here to provide the November 2021 economic and investment update. The financial markets had an interesting month as stock markets globally had a real strong start to the month, and in fact, in the middle to later part of the month, hit record highs for many of the indexes. But then, the last couple days of the month, news broke of the new variant of the coronavirus, which concerned the financial markets, and they sold off fairly sharply the last couple of days, which led to the end of the month returns being slightly to modestly negative for most major stock indexes. Fixed income investments also had an interesting month. Interest rates rose during the first part of the month, but again, as concerns rose regarding the coronavirus variant, interest rates declined, and at the end of the day, fixed income was essentially flat for the month. So we had some new all-time highs, but then a sell-off toward the end. We had a fair amount of news during the month, a lot of it related to the Federal Reserve, the broader economy, inflation, and the consumer spending. And with that, I'm going to turn it over to Dan to talk to us a little bit about some of the news regarding the Federal Reserve.
Thanks, Scott. So the Fed had a regularly scheduled meeting early November, and they finally committed to drawing down or reducing the amount of their monthly bond purchases. So the Fed, since last spring, has been purchasing $120 billion worth of bonds every month. And in early November, they committed to begin tapering the amount of those bond purchases as early as late November. So we expect them to reduce their bond purchases by about $15 billion per month. So if we extrapolate that trend out, that means that the bond purchasing program should come to an end sometime in mid-2022. We learned very late in the month during a Jerome Powell testimony that he hinted that the Fed could actually speed up the amount of the taper and draw it down actually quicker than what they forecasted early in the month, primarily due to the fact that inflation tends to remain fairly high and sticky, and the Fed is starting to express some concern about it. And lastly, on the Fed, we learned that Jerome Powell was reappointed to another 4-year term by President Joe Biden. So I think the markets kind of took comfort in that they will continue fairly consistent monetary policy. So that's an update on monetary policy. And Scott, why don't I turn it back to you for an update on fiscal policy and spending?
So during the month, President Biden signed the bipartisan infrastructure bill. The key takeaway that we want to share with everyone related to that bill is the fact that while there's going to be $536 billion of incremental spending related to the infrastructure, the majority of that spending isn't going to occur immediately, and instead, the first meaningful spending is going to be in 2024, and the peak spending is going to be in 2026 and 2027. So while we think that will provide an economic boost to the economy, it's going to be delayed, and we shouldn't be expecting significant impacts to the economy in the short run. With that, let me turn it back over to Dan to give us a quick update on inflation and oil prices and consumer spending.
Thanks, Scott. So yeah, we've been paying very close attention to energy costs just because it's a big part of the consumer spending for GDP, that is. And we've noticed that energy costs of all types, oil, natural gas, gasoline prices have gone up tremendously. In fact, the graph that we're showing shows that gasoline prices are at a 7-year high. To date, we haven't really seen the consumer being impacted by this. So that is positive news. And as far as we look at predictions for the consumer's spending period during the holiday season, November, December, we've seen estimates that this should be a record season, both in the growth rate and the total amount spent on the consumer. But again, we're paying very close attention to see if consumer spending falls off due to the higher energy prices. So Scott, how about an outlook from Richardson Financial?
We place our outlook as cautiously optimistic. We're obviously carefully monitoring the news related to the new variant of the coronavirus, and we're also going to carefully watch the inflation outlook and the Federal Reserve response to it. That said, we still feel pretty optimistic as we have a lot of tailwinds with the employment situation getting stronger and consumer spending remaining very strong. As a result, we haven't made any changes to our investment strategy, and we'll just continue to monitor things carefully as we move forward. With that, I want to thank everyone for joining us. And as always, if you have any questions or concerns, please don't hesitate to reach out to us.